This is the Alhambra Investments Monthly Macro Monitor. It's June 2020, and it's been a while since we've done one of these. A lot of things have come up, but we're going to try and get back on schedule. And so we're going to bring Joe Calhoun in now. Joe, since we did one of the last of these, man, we've had ups and downs and backs and forths. And I think let's start off today talking about perception, because since the low point in March, the country's reopening. We've got people spending money. We've got people going back to work. Unemployment numbers are better than people thought. And I'll put it that way. It's not that they're great, but better than people expected. So is that perception or is it reality that things are getting better?
Well, I think things have hit bottom and they've started to improve. And we're seeing that in some of the more non-traditional economic series that we've been looking at. I mean, it's very difficult because the economic data, the official economic data that gets released is on quite a lag. So most of the data we have available to us is from April. We do have a couple of reports from May, but we look at things like airline traffic. You know, we can look at the TSA throughput, and it has improved off the lows, no doubt. Same thing with hotel occupancy. Those things have both improved quite a bit. And of course, travel is going to be, I think, probably the industry that is the toughest to takes the longest to recover. But you know, when you look at those things, people are all excited about them improving and coming off the lows. But airport traffic is still down 80%. Hotel occupancy is still down by half. These are not good numbers. I would just say that I think a lot of people in the stock market are concentrating on rates of change. Yes, things are getting better coming off the lows, but I think we probably need to pay a little more attention to the levels. So perception or reality? Well, perception is right that things are improving, but reality is that we got a long way to go.
Well, retail sales falls into that. I mean, May is one of the few numbers we have with retail sales. And the retail sales look really good, but when you had none, it's not hard to look good when it comes back.
Yeah, you know, it's an interesting phenomenon, right? I mean, retail sales were up 17% in change in May. It sounds great, except, you know, the hole we dug in March and April was just enormous. So when you look at it, retail sales are still down 8% since January, down over 6% year over year. Again, let's pay a little bit of attention. They're not great numbers. They're not good numbers at all, in fact. An 8% drop in retail sales in a matter of a few months is just grim. Um, you know, and I wonder too how much things are going to come back. It's something I've been thinking a lot about. How much are people's behavior going to change? You know, I wonder how many people sat at home for the last few months and discovered that they actually could save money if they stopped spending money on stupid stuff, or maybe just had a little bit of discipline with their spending, that they could save a lot of money. And I hope anyway, that people look at that and go, you know, I really like that. And we've seen that in a couple of instances. We've seen, for instance, outstanding credit card balances have fallen over the first couple of months of this virus. So people are taking this opportunity to use what money they have, income they have, or maybe their bonuses from the government to pay down some debt, which is savings in a sense. So yeah, retail sales, yes, big change in 1 month, and we're still down a bunch.
Well, there's another part to retail sales, and that's inventory to sales, because we had that long period of time nobody was buying anything. So you had the inventory sitting on the shelves. Do you think it's going to take a while to clear the inventory before production really starts to key up?
Well, and that's the interesting thing. One of the only other data points we got for May was industrial production, which was up a little over 1%. So retail sales were up a bunch, absolutely, from April. But you know, the inventory to sales ratios we don't have for May yet. We have them for April. They're very, very high. But yeah, they're obviously they're going to have to work off that inventory before they start producing more stuff. Now, here's an interesting tidbit, though. I'm one of those weird people that when I go to a store, I ask the people that wait on me how things are going, because I think a lot of times you get more information that way. So I had to go to Best Buy yesterday to pick up a computer cord, And I asked the guy who happened to be the manager of this Best Buy store, and I said, how are things going? And he goes, well, since we opened back up, things are definitely improving. He said, we're doing about $30,000 a day now. And I said, well, how does that compare? He goes, well, when we were doing curbside pickup during the shutdown, we were doing $15,000 a day. I said, oh, so you've doubled. He said, well, yeah, but we're still down from 60. So again, down by half. The interesting thing though was I said, well, is it picking up pretty steadily? He goes, yeah. He said, my big problem is inventory. I said, oh, you got too much stuff? And he goes, no, I don't have enough. I said, what do you mean? He goes, well, electronics, all this stuff, they stopped making it for a couple of months because Asia was shut down, China was shut down, and we stopped buying it because we didn't have anybody to sell it to. So now we have to crank things back up, and it takes time to get this production out the door and get it shipped here and get it on the store shelves. So he said, my biggest problem right now is I have a lack of inventory. So overall, there is an inventory problem in that there's too much. But in some instances, in some product categories, you actually have no inventory. And I would just say that that is the very unique part of this recession, crisis, whatever you want to call it, is that it is not just a demand side problem. It's a supply side problem too. And it's going to take, I think, months to work out these supply issues, whether it's not enough supply or too much. But it's not going to happen quickly.
Well, in all of this sea of bad news, there were a couple of bright spots in the reports. Personal income was one, and housing was one. And I don't know whether those are short-term positives or long-term positives, but there wasn't much else to be happy about.
No, there wasn't a lot. There wasn't a sea of green there. There's not a lot of green shoots, if that's what you're looking for. There were a few. Yeah, let's talk about the income number. The income number, obviously, it looks great. Hey, income went up. Yeah, except it was stimulus payments and one-time cash payments, and one-time cash stimulus payments and the enhanced unemployment benefits from the federal government of $600 a week. Um, so yes, income went up. Is it permanent? No. That's going to go away. The expanded unemployment benefits from the federal government is supposed to go away at the end of July, and there's been no talk yet of an additional stimulus payment. Although I did hear yesterday that Republicans in the Senate are apparently upset with Steve Mnuchin because he was talking to the Democrats in the House about this and saying that there would be another stimulus payment and that they did want to extend the unemployment benefits. I would just say that while it's not permanent, it may be longer than people expect. I think that politicians are trying to get elected here. Remember, it's an election year, so I would suggest that if President Trump's poll numbers continue to be weak, that we will see an extension of unemployment benefits and probably another stimulus payment. Uh, how long that lasts, I'm not sure. But point is, it is temporary. You got to put people back to work to make that number better on a permanent basis. On the housing side, it's very interesting. Look, we're seeing big numbers in mortgage applications, on purchase applications, and on refi. Um, but yesterday we got new home sales, or excuse me, housing starts, which were really not very good. Under a million, 900 and something thousand. That's down quite a bit from where it was prior to the crisis, but it is, I think, probably going to pick up because permits did pick up. We also got one of the few May numbers we got was the housing market index, which is essentially a sentiment survey of builders, which was jumped back above 50 to 58. 50 is kind of the dividing line between contraction and expansion. We also saw an earnings report out of Lennar that was pretty good. And Lennar said things are going back to normal. So people are buying houses. And I think there's a couple of things going on there. I think there is certainly this movement away from cities is already starting. Something we've talked about before, how there's, I think, less cities are less attractive now because of the virus and so forth, and people are finding out that they can work from home. And they're moving. That's part of it. The other part is, quite frankly, mortgage rates just hit all time lows, and we're talking, 3.5% mortgage rates, and that makes housing a lot more affordable. And I think right now, actually, prices are still going up. I think it may be again an inventory problem. You shut down a lot of construction and stuff during that couple of months. They're probably going to have to play some catch up. So housing does look okay, at least for now.
Well, let's take that interest rate conversation a little further and talk about the bond market because Treasury rates are still very low. You've got QE. It didn't work the last three times. I don't know why they think it will work this time. What does all that say about growth, and how does that contrast with what the stock market's saying?
Well, it's the conundrum, right? The stock market is almost fully recovered or is fully recovered from the losses in March and in March. And if you believe the stock market, then it looks like the recovery's on track and everything's going to go back to normal and everything's wonderful. And the bond market says not so much. The 10-year Treasury note is still trading around 70 basis points. That does not say anything good about growth. And I would say that even more negative is real rates, tips market. The tips market, the 10-year tip is trading for, yesterday hit a negative 57 basis points. That is about as low as it's been this entire cycle since their last crisis in 2008. That's an indication of real growth expectations, and it is grim. That number, by the way, is actually lower than it was in early March. So we've seen absolutely no improvement in real rates, even though we've seen a slight improvement in nominal rates. What that means is inflation expectations have come off the lows, but they're still in a downtrend. Well, QE may work in somebody's mind, but it doesn't work in the real world. We've seen this repeatedly. People think that QE is going to work, that it has this magical power, but it doesn't. And I would just point out that this is the conundrum that we've seen with QE from the very beginning, which is that QE, if you believe the Fed, is designed to lower long-term interest rates to stimulate borrowing, to stimulate the economy. But evidence of its success would be higher rates. So if the market believed that QE was going to be effective, then nominal rates would already be higher, and they're not. So whatever the Fed is doing now, whatever you want to call it, you can call it QE, you can call it, I don't know, virus buying, I don't know, whatever you want to call it. It doesn't mean anything. Jeff and I have talked about this endlessly. All you're doing is swapping a treasury for reserves at the Fed. It's just an asset swap. It doesn't do anything,
Hey,
and it's not going
swamp,
to do anything this time either.
swamp, wetlands, I don't care what you call it, it's still the same thing.
There you go, man. It's damp.
No question about it, we are in a recession. And the yield curve has always been a pretty good indicator for us, whether we're going in or coming out. But this thing hits so fast. I mean, what's the yield curve telling you right now?
Yeah, the yield curve really is kind of confusing at this point. We have had a steepening that we would normally see at the beginning of a recession, where short-term rates went down faster than long-term rates. That is a negative steepening. Uh, Ironically called a bull steepener, but that's a misnomer. Um, we would normally see that steepening prior to recession. In this case, it kind of happened after the recession already started because of the suddenness of this onset of this recession because of the virus. What worries me more is that we're sitting here at 50 basis points, basically, or not even quite that high. Whereas in past recessions, the yield curve peaked at 250, 300 basis points. And it peaked at when the economy was at its worst. Well, we're only at 50 basis points now. Are we really going to go to 250? If we are, how are we going to get there? It would seem to me that the only way to get there would be for long-term rates to go up, which would be an indication that we've done something or policy has changed in some way that's a positive for growth. We haven't seen that yet. You can't make short rates go any lower. So if you're going to steepen the curve, it's got to be because long rates go up. Point is that wherever the yield curve peaks, that's usually where the bottom of the recession is. And we're not even close to where we've been in the past. So I'm not sure how that's going to play out. It's going to be very interesting. This may be as steep as it gets in this cycle. I really don't know. We're kind of in uncharted territory here with the yield curve. I'm not sure what to expect. Put it that way.
Well, talk to us about credit spreads because that's been another one of our indicators about going in or coming out of recession. Are credit spreads confirming what the yield curve is saying?
Yeah, well, sort of, but the credit spreads are distorted here. The problem is that the Fed's buying everything that's not nailed down, including junk bonds. And so credit spreads, when we look at junk bond credit spreads, when the Fed made that announcement back in April or March or whenever it was that they're going to buy junk bonds, everybody rushed in and bought HYG and JNK, the junk bond ETFs. They're trying to front run the Fed. They're thinking, hey, I'll buy these things before the Fed does, and the Fed will run the price up. Well, what that does is narrow credit spreads. So, is that real? I, I'm not sure what to believe from credit spreads. Theoretically, I suppose it doesn't matter why credit spreads narrow as long as they do, because that will allow companies to borrow money. On the other hand, you're going to get a bunch of companies borrowing money that probably shouldn't be able to borrow money, that probably ought to go out of business. So there's a double-edged sword there. Look, what I can tell you right now is that credit spreads are still elevated, but they're not at a level that would normally concern us. So in some ways, it's just kind of stuck in the middle. I would say that it's not confirming anything right now.
Well, if the government's buying everything, I've got some stuff I'd like to sell them. Who do I talk to? Uh,
Yeah, I wish I could get on that buy list myself. I've got some things out in my garage I'd really like to get rid of.
hey, let's talk some real specifics here. The dollar. Any indication the dollar's going to get weaker?
No, that's one of the things we're watching for here, because we oftentimes see when we have recessions or big dislocations that we get a regime shift from strong dollar to weak dollar, strong dollar, whatever. Look, we've had some weakness in the dollar recently, but it's not significant. We're still have a fairly strong dollar. I think there may be some differences between what they're doing with the Fed this time than last time that may lead to a weaker dollar, but we're going to wait to see it. Right now, we still have to call the dollar strong. But I think anybody that's looking at the euro has got to be wondering why it's not at par already. I mean, they're making that call for almost 5 years now, saying, "Oh, the euro is going to go down. The euro is going to go down," and it really doesn't. So, I would just say that the dollar's been moving sideways essentially since 2015. It's traded in a range, and we're still in that range. It is at a stronger level than it was in, most of the gain in the dollar in this cycle came in 2014. It made a big move up. There was another big move up after Trump was elected, but that was given back in a matter of months. And basically, like I said, we've been moving sideways for almost 5 years now. So that hasn't changed.
Okay, gold in an uptrend since 2016, really started to accelerate in 2018, but then it stalled when stocks were just on the run they were on. Any chance that the uptrend in gold is going to resume?
Well, I think that would take some more dollar weakness, but let's talk about gold for a second. It's a very interesting situation here. Normally, we would expect gold to rise with a falling dollar. In this case, we got gold to rise from roughly 1,050 all the way up to 1,700 and change, really with no dollar weakness at all. Now, people who believe that gold is a better indicator would tell you that that means that all currencies are devaluing against real stuff. That the dollar has devalued, it just hasn't devalued against the euro because they're devaluing as fast as we are. I'm not sure I completely buy that. I think part of the buying in gold has been based on fear, but it doesn't really matter. In some ways, gold being at 1,700 is an indication that we've already had an inflation, that the dollar value, relative dollar value versus the yen, the euro, and so forth really is not the thing that matters. Again, I'm not sure, but I would just say that if gold is going to break out here and we are up near those highs that we set in 2011, if we're going to break out and go to new highs, the dollar's probably going to have to fall. So we'll see. Look, the gold has stalled since mid-April because stocks have rallied. People don't put money in gold when stocks are rallying. They put money in stocks. They put money in the thing that's moving. So we haven't seen a lot of money come into gold. In fact, what we've really seen in gold, if we're looking at the futures market, is we've seen the speculative bets on gold actually fade a little bit. So not quite as bullish on gold. The market is not quite as bullish on gold as it has been. We'll see what happens. I would venture to say that if the economy doesn't recover as quickly as stocks think, gold will go higher.
All right, general commodities, a little bit off their lows, but they're still way off. Copper to gold ratios in a short-term uptrend. Shouldn't interest rates be going up?
Yeah, we have seen that, and there has been a divergence here between interest rates and the copper to gold ratio. The copper to gold ratio is a very good indicator for interest rates. Interest rates tend to track that ratio. There's been a divergence now where copper to gold ratio has recovered to a certain level, but interest rates have not followed. So one of two things is going to happen here. Either the recovery is going to falter and the copper to gold ratio will fall back, or the economy will accelerate and interest rates will rise. I don't know which it's going to be, but that gap will get closed at some point. The commodities are off their lows. Copper and oil are obviously in these short-term uptrends. They're still down quite a bit from where they were. It's kind of like the economic stats and kind of like, looking at that airport traffic. Yeah, it's up from the lows and there's a rate of change there that's positive, but it's still way down.
You have said many times that our job is not predicting the future, but analyzing accurately the present. So, what's your interpretation of what's going on right now? And then also want to talk about our four box matrix at some point.
Okay. Well, I think that right now where things are getting better slowly. I think maybe the stock market is a little ahead of itself, but in general, we don't see a huge recovery here. We're not seeing a big move back to the previous levels. How much that's going to matter for investment, I'm not exactly sure. I mean, rates of change do matter. Um, but right now, things are getting better, but they're still not very good. So it's a very general statement, but that's where we are.
Well, one of the things that we use in our investing process is that four box matrix. We have
Right.
two boxes where you have a rising dollar with either rising growth or falling growth, and then a falling dollar with rising growth or uh, falling dollar. So, where do we find ourselves right now? Which of those four quadrants?
Well, during the worst part of this, we were obviously in box four, which is rising dollar and falling growth. That is the worst place to be because there's not much that works. Treasuries work, and that's about it. Treasuries, cash, being short, those types of things work, but not much else. What we're trying to figure out is where we're going to go from here. And I think there is a contingent that believes we will go to a falling dollar, rising growth environment. And there's a contingent that believes we're just going to stay where we are, which is right, or where we were before this, which was rising dollar and rising growth. Now, look, we've been in that rising dollar, falling growth box a lot longer than just the beginning of this recession. We had been in that box for over a year. Growth was moderating long before we got to the virus thing where we fell off a cliff. I think there is now the stock market is telling us that there's a contingent that believes we're going to go back to strong dollar, rising growth. That's what the stock market is trying to say. The bond market doesn't agree. I don't know where we're going to go, but right now people are trying to force us into that box of rising growth, rising dollar. I don't think we're quite there yet. Rising growth is one thing, but the level matters, put it that way. We'll see if we stall here. That's what I'm worried about. Look, I've said all along, I think that what's going to happen here is you're going to get a steep recovery. Call it a V, call it whatever you want. I've referred to it as a square root symbol because I think what's going to happen here is you're going to recover some percentage of what we lost. 80%, 90%, 95%. I don't know what the number is. And we're going to get back a big chunk of it. And then there's a chunk that got eliminated permanently. There are a lot of businesses in this country that went bankrupt during this. They're not coming back. Now, eventually those people will go do something else, but not right now. So, four box matrix, I don't know where we're going. I think we are still in weak growth, strong dollar. If that's where we are, you still need to be very, very cautious.